favorite movie and why?
Favorite movie and why? Good Will Hunting. Has to be Good Will Hunting. There's some moments in the movie, I share my story about my dad and my brother, and your two closest male relatives, convicted felons, and dude, my dad and my brother are really good people. And I know a lot of people will shake their head at this dude. My brother hasn't so much got a parking ticket since he got out of prison, right? He's got a fantastic job. He's kicking ass. He's taking names. He's got a great wife. His life is good. The fact that he got knocked down like he did and got back up is so remarkable. But I remember the scene, Robin Williams is it's not your fault. It resonated with me. I used to take the burden of what they did and think it was my fault. I used to think dude, I'm just, I'm just like them. I'm poor white trash, whatever, whatever. And they're not it's just, but there was this subconscious level of, you can be something more than what you're not.
Welcome to the On the Edge podcast with your host, Scott Groves.
Hey, what's up, ladies and gentlemen? It's Scott Groves with the On the Edge podcast. I'm here with my old friend and strange investment partner, Kevin Ducey. So Kevin is head of sales, I guess, or head of client satisfaction or something for a company called Comma Insurance. And think of Comma Insurance kind of like a McDonald's. You buy a franchise-y, kind of, sort of. I think there's some legal terminology there that we'll get into, but effectively you're like a franchise owner of an insurance company. Myself and four buddies of mine, couple realtors, couple lenders, went in, bought an insurance company 2 years ago where we have to fill out all kinds of forms so that we can legally refer our clients there. And then we tell our clients, hey, use whoever you want, but we have trust in this company, Comma Insurance, if you want to get your insurance quote. And it turns out most of my investments in everything except for the mortgage space and consolidated coaching, worst timing ever to invest in an insurance company because shortly thereafter, the state of California just shot themselves in the foot and it's almost impossible to get homeowners insurance in the state of California. State Farm is canceling all their policies or not renewing them. Insurance companies are pulling out. So I got to imagine, worst time for me ever to buy an insurance agency and probably worst time for you to be selling insurance agencies. So welcome, Kevin. We'll get into some of your backstory, but let's just hit it hard right off the bat. Why is it so hard to get insurance in America right now in certain places?
Well, let me correct you slightly.
Okay, go for it.
You were probably 1 year away from the worst timing ever. At least we got about 18 months of decency. Yeah. With writing some policies for you. So if you would have done it a year later, it would have been an absolute shit show. So why is it hard? Why? It's a really unique situation, specifically when we're talking about California, right? Everything in California is more expensive. There's a reason you no longer live there, right? I mean, except for insurance. I mean, you would look at a house of $1.2 million house somewhere in California, 2,000 square feet, whatever that may be, and you would have a $1,800 home insurance policy where you take a $1.2 million house. Now, granted, it's going to be a lot bigger where I'm from in Oklahoma. I mean, you're looking at $4,000 or $5,000 home policy. Right. And those policies were kept at bay specifically by the California state government and their insurance commissioner. And it's been done that way for many years, trying to protect Californians from paying too much for insurance. And frankly, in 2022, the insurance industry as a whole in the United States of America lost 8%. That means they paid out more claims than they received in rate by 8%. And I know some people might be thinking about this 8% is a fairly decent number, but doesn't sound massive. That's $36 billion.
So insurance companies overall in 2022, all the premiums they took in versus what they paid out in claims and construction and new roofs and everything, they lost how much? $30 billion?
Just shy of $36 billion.
Got it. So a lot of money.
Yeah, and then we followed it up in 23 with a 5% loss, which is about $24 billion. So, $60 billion in losses for companies like State Farm, Progressive, Allstate. And it's been really hard. And then you factor in the fact that 11% of the population lives in the state of California. Massive amount of claims in the state of California. Fires. I mean, they just got hammered. And so what happened was the linchpin to this whole situation, which is insurance is completely unique in this regard. State Farm said, screw it. We're not writing any new policies. In fact, they're not.
In the state of California.
In the state of California. They're just we're not doing anything new. You move, you want to a new house, you had State Farm before, tough shit, go somewhere else. And typically, my capitalist mind frame says, well, if the biggest carrier in the nation isn't going to write policies, if I'm Allstate, I'm jumping all over that. Insurance doesn't work that way. It's not like when a Starbucks goes out of business across the street from your coffee shop, you're excited. You're like, cool, I'm going to get all their business. No, that's a red flag, especially when it's someone like State Farm. They're like, that's the oh shit signal. We can't write insurance here. This is dangerous. This is a fool's errand. We're going to lose money. And there is legislation on the books. And my understanding of this, and I don't pretend to be an expert here, in the state legislature in California, that it was both parties approved it, and now it's being stopped, shunted, slowed by the corporate watchdogs. That started in September of last year, and we have not reached anywhere where the carriers are coming back into it. To the point you already made, State Farm said we're not doing any renewals. That's going to lead to the fact State Farm has no business in a state of 39 million people in America, 11% of the population. That's insane. So really hopeful, knock on wood, if you will, that we can get some of this legislation passed. Part of the thing that in most states, when you pay for your insurance premium policy, some of that money is going to what we call reinsured. So Lloyd's of London, if you will, that is insuring the insurance company in case they have the situation with an 8% loss.
This is how Warren Buffett and Berkshire Hathaway got so rich, right? They're like the reinsurance company for insurance companies.
Absolutely.
So if
they're also Geico, right?
Okay. So if State Farm takes like a massive loss because there's a wildfire in Malibu and everybody in the canyon had State Farm, and they're basically on the hook for, hundreds of millions or billions of dollars of rebuilding houses, they will go to their reinsurer, correct, which is Lloyd's of London, Berkshire Hathaway, probably BlackRock has some version of it or something like that.
Absolutely.
And then that's the insurance company for the insurance company.
Yes, and in California, none of your premium can go to reinsurance. That's been mandated by law, and that's one of the really key components that's in this legislature that's going to change eventually. I think it has to. We can't sit here in the most populated state. But what's California from a GDP standpoint in the world? I mean, it's insanely.
It's like
high.
7th or 8th highest GDP in the world.
In the world,
the state of California.
And there has to be something to be done. I don't know if the federal government will get involved. You know my feelings on that. I don't want them involved, but at some point in time, we got to pull our head out of our ass so people can be able to. Or otherwise, you're not going to be able to own a home. It's mandated by law. You have to have insurance. Like someplace the rubber's going to meet the road here. So.
Yeah. So I'll use my own political opinions because, we'll just go with my own political opinions. Government, this is the libertarian me. Government is so frequently the problem, and then they pretend to be the solution. So here's my understanding of the insurance debacle is back in the 80s, the state of California passed Prop 13, which was a cap on property taxes. And they said, effectively, we don't want old people getting pushed out of their houses because we keep raising their property taxes. So state of California is unique, unlike Oklahoma or Texas, where they just constantly keep reassessing your property value. And in the state of California, if you buy a house and you own it for 30 years, your property tax goes up like a minuscule amount. So you can have a tax basis of a house at like $300,000, but your house is worth $2 million because it's been in the family for 30 years, and your property tax is just tiny because it's taxed on that original $300,000. Okay, you can argue all day long whether it's a good policy, bad policy, whatever. It's had some weird downstream effects, but for the most people, for the most part, I agree. I don't want old people getting forced out of their home because they can't pay their property taxes. And Chris, you're gonna have to look this up. Like, what year was it on the ballot measure to add a state insurance commissioner in California? Because once they passed that, the next idea was like, okay, well, if we're going to help people keep their cost of housing low on taxes, we should just do the same thing on insurance. And so under the guise of being like consumer friendly, the government in California created more government and more departments, this Department of Insurance. Now we have an elected official who's the commissioner of insurance. And that guy came in and said, hey, the way that we capped property taxes, we're now going to cap all the carriers with homeowners insurance. And you cannot raise your homeowners insurance costs commiserate with the actual cost of providing insurance. So my mom, for example, insured through Mercury, she has a 3-bedroom, 2-bath house on the top of a hill in a fire zone in Eagle Rock, 1,400 square feet, huge lot, $1 million house because it's been in the family forever. I think her homeowner's insurance is like $680 a year. It's like an absurd premium. And to like actually cover the cost of what should be commiserate with that risk, her policy should be $3,000 or $4,000 a year. But the commissioner of insurance of California just says, no, you can't raise it. So then the option is Mercury one day is going to come and be like, dude, we're so out of whack with what you're paying on premium on what a potential claim would be. We're just canceling your insurance, or we're not canceling. We're just not renewing it next year. And so now all of a sudden government created the problem, and now they're coming in and be like, well, we need more government for the solution. Let's figure out what's going on. Where if you would have just let the insurance company charge what they need to charge to stay profitable and solvent, but like State Farm can't keep losing $1 billion a year in California and writing insurance. Did I surmise all of that more or less how we understand it?
Yeah, probably better than I understand it, right?
I watch a lot of podcasts.
Right. It's one of those things, like here I am speaking as kind of an insurance, the way you're presenting it, the way we're talking, like I'm an insurance expert. I'm really not, but I'm having to learn this stuff because my clients, my customers, and people I care about, such as yourself, it's like, oh shit, what's going on? And the first inclination was, it's our fault, right? I mean, because I can fix our problem, and that's always the place we go. And then come to find out, man, this is a lot bigger than us, man. And it's affecting Texas now. It's affecting Florida. New York already has some struggles with it, and man, that's a third of the nation's population.
Yeah,
Florida brought in Citizens a few years ago, which is a government subsidized insurance agency. It's not a good insurance. I mean, it's not bad insurance agency, but because they had to deal with the same thing. Now, theirs is a little bit different. I mean, obviously fires in California are huge, but theirs is hurricanes that just come in and wipe out entire neighborhoods. And you can't predict it. I mean, it's similar in the fires, but I would say that hurricanes are probably fires are preventable, right? I mean, there's things that we can figure out and things that we can do. The hurricanes, you can't
clear brush around your house and prevent a hurricane.
Right.
Like, this just doesn't happen.
That son of a bitch is coming whether you like it or not.
Yeah, I know in California, we have California Fair Plan, which is, it's so weird, and I've never understood this, because California Fair Plan is the insurance of last resort run by the state. And if you apply, they have to give you insurance.
Right.
But
it's normally an additive.
Yeah.
Right? It's an add-on policy.
But the problem is they take like 3 or 4 weeks to respond. So here we are, like ready with loan docs. I'm ready to send out the thing. And I look like the bad guy. They're like, well, Scott, why hasn't your team got the proof of insurance yet? It's like, no, we requested it 3 weeks ago. It's just California Fair Plan is totally overwhelmed. And what scares me is like, what if there's a catastrophe and California Fair Plan doesn't have the financial backing? They go bankrupt, and the state has to step in and pay off that fund. Then it's more taxes. And it's just like, dude, we've just created this giant problem and this giant bureaucracy where if you would have just let Allstate, Farmers, Geico, Goosehead, whoever charge what they need to charge in order to like cover policies, we'd be good. Did you find out, Chris, when the insurance commissioner? Oh, 1988. Yeah. So shortly after Prop 13, I think Prop 13 was 1983 or 1982, something like that. Then they tried to cap insurance. And my understanding was from like about 1990 until a couple years ago when this came to a head, the rest of the country was just kind of subsidizing the cost of insurance for places like California because we were like legally not allowed to pay our fair share because of the state commissioner.
Right. Absolutely. So you have these big carriers that obviously want to play in California just because of the size, which we've alluded to multiple times, but you understand that you're making more money in other states to offset it. And it's fascinating and it sucks all at the same time. It's just the macroeconomics of this and how it all reared its head at the same time. And just like everything else, COVID and the government's decisions to either not raise rates in time and keep rates low and funnel money back into the American taxpayers' hands for nothing. My wife and I got a check. I don't even know why. I'm still baffled by this. Our lives were not impacted from a business standpoint with COVID. We had to work from home. That was it, right? And we were probably shitty parents for a while because we were on Zoom calls constantly while my kids were playing video games and drove me nuts. But this massive level of inflation that we saw so quickly and the massive rise in what homes are worth, home values, drove all this, right? Because then reconstruction costs shot through the roof, price of goods shot through the roof, price of labor shot through the roof, and that's why it really reared its head about the back half of 22 because insurance is going to have a lag. Right, well, insurance is always going to lag behind inflation because you sign up for your policy today and 8 months later we start to see some massive rise in inflation. Well, your policy's locked in for another 4 months, so you're not going to get hit by it. And so that's why we saw it the back half of 22 and the first half of 2023. I think it'll lag with inflation as well as it's coming down and as the market settles as we go into this recession that we're already in.
Yes.
If anybody listened to Danielle DiMartino Booth yesterday at Mastermind Summit, which I don't know if you saw that, but
she's excellent.
She is. She's phenomenal. It's like all the data says we're in a recession except for the federal government fudging the numbers.
So let's talk about how comma works when insurance is a normalized market. So, we bought into a comma agency, or we bought in a common agency, and then there should be a lot of carriers there, and the insurance agent who we pay to service our clients has a ton of options to basically broker out insurance to the best source. So like when we started a couple of years ago, before, the proverbial shit hit the fan, like how many carriers did we have in California? What was kind of our market pool? Like what's the benefit to the consumer as far as, getting their insurance with comma?
Right. So we probably had a dozen that we would really look at your core. Your core is probably about 5 or 6. It's like anything else. Those are the ones that seem to work. We're comfortable with them. They seem to be responsive to our needs. And then you probably had 5 or 6 offshoots. And then we probably had a couple other that were very rarely used in the state of California. And it's interesting. It's like you don't have a comma agency. You have an LLC that is doing business as comma as part of the management contract that we have. And yes, we found the insurance agent for you, and then you refer your clients and she's able to write it. I would say one of the biggest differentiators that we have comparatively to the rest of the markets of the networks is like we retain policies at about 7% above industry average. And it's our back-end account management team that is solely focused on getting renewals and getting remarkets and being very proactive. What I mean by remarket is that's when you shift from Travelers to Progressive to Allstate, and so on and so forth. And so our team on the back end is really proactive in that. So we're not relying, a lot of times we're relying on a salesperson to do that. Mm-hmm. And that's a different skill. Like salespeople should be hunters, maybe a little bit of farming. That's farming, right? And you need somebody with a better skill set to do that. So we've allocated that. We found the right people for the right roles there. And it's allowed our business owners to, because nobody makes money on insurance on a 1-year policy. There's nobody in insurance that would tell you they want a 1-year policy. The typical average, or at least it has been, is that the average American reviews their insurance policies about once every 8.5 years, which is ridiculous. So that's stupidity on Americans' parts. But insurance sucks. I mean, it just sucks. I mean, let's be real. Every time you go through the process, you're like, this is just a bill I got to pay. I don't want to deal with this crap. And there's minutia and all the stuff that's behind it. And so that's why there's that once every 8.5 years. Now, that's not happening now because we're seeing states that are seeing 50% increases in premiums. Top 3 states, Texas, Colorado, Arizona, all above 50% insurance premiums rising over the past couple of years. So that's putting more of the burden on our teams to figure out and how they can do that. And it's putting a burden on every team that's out there. I just think that our systems and the way that we were built is probably more aligned for keeping those clients happy and keeping them in our network.
Because the benefit is, and correct me if I'm wrong here, like if you work for Allstate or State Farm or Farmers or whatever, you're a captive agent. You can only write insurance through that one source.
Correct.
But if somebody comes to our gal here at Comma and wants insurance, she can shop around to different providers and see who's better. And then even after we have the policy, we can change the policy from company A to company B if there's, significant difference in premium. Is that correct?
That's correct. And Allstate's a little bit of a blended model in the fact that they do have captive agencies, but they've got into the brokering space as well. I don't see State Farm doing that in any capacity. That's just not, they're the one themselves, USAA, AAA probably are not going to go down that route, is my guess. And like I said, I don't pretend to be an insurance expert. But because Farmers has a program that they broker out, and it's part of who they are. Allstate did it for years with Encompass, and now they're doing it as Allstate with us a little bit. But yes, it's being able to just shop your policies in multitude of directions, right? And then also with us it's being able to move your policies and still stay in essence with the same support staff, the same support company, and moving it.
Same insurance agent.
Right, absolutely. And it provides that comfort there as opposed to like you worked with your State Farm guy forever and now you're going to go somewhere else and there's a little bit of lack of connection there. I mean, State Farm's a phenomenal company. I mean, they've done some incredible things. I'm not shitting on them here in this. And one of the ways that the loan officers that might be on this or the real estate folks that might be on this, and it's like they're seeing a lot of folks going with State Farm, it's because in other states where they can write, they are trying to come in with low premiums because they understand that the average American, once the insurance market settles, isn't going to review their policies once every 8.5 years, and they can get them on renewal increases.
Right. Hey, this quick interruption is brought to you by me, Scott Groves, the host of the On the Edge podcast. This podcast is brought to you
by me. I'm a loan officer who can help you with a mortgage in all 50 states across the United States. I also coach loan officers. So if you are a home buyer who's looking to get a mortgage, if you're a realtor who's looking to partner with an awesome loan officer, or if you're a loan officer looking for coaching, get in touch with me. It's those sources of revenue that allow us to produce this podcast and get out a new episode to you every week for the last couple of years. So if you're looking for a mortgage, if you're looking for a mortgage lender to partner with, or you're looking for a mortgage coach, I'm your guy. Now back to your regularly scheduled programming.
So let's go to why somebody would want to own a comma. Because myself, the realtor, the three other lenders, we went on this. The idea is lenders and realtors, our asset is really our relationships.
Correct.
But there's nothing there to sell. There's no residual income. You start over every month at zero. Nobody has really found a way to sell their database or monetize the realtor or lender space. So it's like, cool, you work 30 years, work yourself to the bone, and every month you start over at zero. And when you're done, hopefully you've saved enough money to retire, maybe, sort of, kind of, sell off some assets. So give the listener the pitch on why people that work in the financial space might want to invest in an LLC that owns a comma insurance company.
Right. So we were created by a loan officer who had that same idea. You're sitting there and you're thinking about it. You don't have a wealth generating asset. You don't have any residual based income. You have a minimal access to your post-funded database. So what part of the transaction could you monetize? And the idea isn't novel. I mean, every time I talk to a loan officer, they're like, man, I've always thought, how could I own insurance? And for the most part, until I think we came into the picture, there wasn't an option out there because of the RESPA constraints, right? And you had to make sure that you were doing this correctly. So what we've done is we found a way that really and here's the other thing. There was either the RESPA constraints or you were going to bifurcate your business. You were going to be a loan officer and own an insurance agency because it was going to require your time and your effort. I mean, I look at you, your insurance agency did really well until we got kicked in the teeth in California. You never wrote an insurance policy.
I don't have to know anything.
You never paid a bill for your insurance agency. It was like, we took care of that for you. And it's all completely RESPA compliant. So the aspect is like really the unique aspect of our model is not necessarily, it's the back end management of it. We're a management company that's providing insurance opportunities. You as the loan officer, all you have to do is change who you refer your business to for insurance. And it's to your insurance agent that's a W-2 employee for you that we manage their production, their performance for you. And so, yeah, do you have to change how you refer your insurance once you own an agency? 100%. Like you've got to be a little bit more, hey, Kevin, who are you going with for your insurance as we get ready to write you this loan? Well, I'm going to stick with State Farm. In the current world, right now, you don't own an insurance agency. You're like, cool, I don't give a shit. POI is just a pain in the ass trying to get docs done. When you own your own insurance agency, you should just push back a little bit. Hey, Kevin, why don't you take a look at my insurance agent I can refer you to? Why don't you just look at their options to broker out and see if they can't save you some money? Just take you 15 minutes, see if they can't save you some money. And if they can save you some money, great. If not, you're properly insured. How do you feel about that? It's a 30-second conversation that could be worth $3,000 to $8,000 a lifetime value for you. And not only that, now you have that client in your insurance world. So what I'm speaking to is today. I mean, how many clients are you reaching out to today and saying, hey, listen, we funded your loan in July of 2020. Would you like to look at what we can do for you from a refinance standpoint?
Yeah, no, that's nobody.
Right. But I could say to them, hey, you're getting kicked in the teeth in insurance premiums. Would you like to take a look at, would you like to meet with my insurance agent and see if they can't save you some money with your insurance?
Which one of these is the tequila that tastes like whiskey?
That one.
The little one.
Oh, dude, it's so good. It's really good. We're not smoking today because I smoked like 3 cigars last night, but I'll have a drink with you.
All right.
I mean, it's noon somewhere.
Yeah, Oklahoma.
It's noon here.
Oh, it's noon here. Perfect. We're good. We're good. Like I said, a little hungover from last night.
And then, I mean, really, if you take the steps and you do the right thing, the first 2 years are the hardest, and you guys are the most patient people in the world.
Because you told me this when we got started. You're like, hey, just all loan officers suck at insurance because you guys are used to meeting a client, writing the loan, getting paid. Insurance is get rich slow. Like you're not making money. Your agency is not making money till year 3 or 4 because you've got to have those renewals coming in, right?
Right. And then what it should do and provides for you, and it has done for some of our agencies, especially the ones that got on the boat really quickly. Those folks who jumped in when we went live in 2020 are seeing great returns. I mean, they're seeing $30, $40, $50, $60,000 quarterly checks. We had one agency that did a cash out refi last year for $300,000, borrowed against the book of the business, and gave their loan officers $35,000, $45,000. Like, here, great. Who couldn't use $35,000, $45,000 extra in your pocket in 2023? And then it's your asset. You own it. It's and you're not doing a ton of work for it that you can sell. And in 10 years, it should be a 7-figure asset that you can sell. And it's not going to fundamentally, like, you're not going to retire in Tahiti but you're going to be able to say, hey, listen, I more or less you can probably ease out of the mortgage game a little bit easier because now I've got residual checks coming in around 6 figures each year. Got an asset I can own or borrow against. It's the idea that it's going to make retirement a lot easier for you and scaling back out of the mortgage business a lot easier for you. I mean, I think about you. God knows, I love you, but you've been in this business a long time. I mean, frankly, you're a little bit burnt out on writing mortgages. Extend that till when you're 60. I mean, how the fuck are you going to feel about writing mortgages then? You're not going to want to do it at all.
Yeah, I mean, thank God that I found Leah. Cheers, man.
Cheers.
That's pretty good.
Oh, that's really good.
Yeah. Thank God I found Leah because like right now as we're doing this, right, which like this supports the greater mission because we're going to send this out to our realtor partners. This is going to sound weird considering I'm happily married. I crush it on the first date.
Right.
Like when I was a little bit more in my gigolo phase, we'll just put it that way. I crushed it on the first date. I'm not great by date 7. Like somehow my wife and we have found our rhythm. It's great, but I'm great at the initial consult, like discovering the client's needs. And that still lights me up. Like, cool, we're going to get you in a house. Oh, we're going to solve this really complicated financial situation. By about phone call 5 or 6 where we've got to get the insurance in line. Like I have to have a Leah to take that over.
Yes.
So like this podcast supports the bigger mission because we're going to make some clips out of this. We're going to send this out to our realtor partners. I've got 2 buyer consults this afternoon that I'm actually looking forward to. But like right now, as we're talking, Leah's digging through tax returns and doing all that stuff. And God forbid you're a loan officer that can't afford that. And you're 30 years into your career having to calculate, net income on the corporate add back in depreciation. That's just like mind-numbing work for a vast majority of loan officers. And there's 0 residual income that comes from it when you're done.
And 0 wealth-generating asset. I mean, you've got to figure out a way to. I mean, that's why I really enjoy it. Every time I'm around, like at this conference this week, and you hear these LOs talk, everybody's talking about their side hustle.
Right.
Like, what like whether it's real estate investing, the market, owning other businesses, concrete companies. You hear all the things. Because you have to do that. Because if you're 30 years into this game and you're just writing mortgages, you're going to write mortgages until you die.
Yeah.
And that sounds like the 7th layer of hell for a lot of people.
Right. I talked to one of the most impactful conversations I had, because I'm working like 40 hours a week in mortgage and then 30 hours a week running coaching company.
Yep.
Right. And people were always like, how do you have so much time? Well, I stopped watching sports. That's how I got 30 hours of my life back. But, doing that, the reason I was willing to put in that extra time to build the coaching business, I sat down with Barry Habib like 8 years ago. We just happened to be at a conference together and he's like, hey, you want to grab lunch? I'm like, yeah, let's go grab lunch. And for the realtors that don't know, Barry Habib is the man in the real estate space as far as informing people about interest rates and giving you kind of the graphs and the charts and the technical stuff about all of that. And so Barry sat me down and he's like, hey man, let's go over the math. Like if you crush it as a loan officer, you're making $400,000 or $500,000 a year. A third's going to taxes, a third's going to lifestyle because you're not going to make $500,000 a year and live like a pauper.
Nope.
And we went through all the math, and he's like, over a 25-year career, you might, if you time the market correctly, you don't invest poorly, you don't get caught up of depleting your assets in down cycles like we're in right now. If you do all the things correct, you might end up with $2 million of investable assets when you are ready to retire after making these companies and Fannie Mae and Freddie Mac and your borrowers and your realtors. Like you've literally created, we did the math right there. He's like, you've created over your 25-year career, like like $100 million
Yes.
of wealth for everybody else in real estate and commissions and overrides and whatnot. And you've got about $2 million if you did everything right. He's like, however, if you spend a little bit of your money investing either in real estate or building your side business, you get to here, you do there, somebody will buy that business for a 2-time multiplier, or you can sell all of the real estate property and whatnot. He showed me a path to end up with $5 million in liquid cash at retirement instead of $2 million. And I'm like, oh yeah, that's totally worth giving up the UCLA Bruins and the Los Angeles Lakers to like make sure my family's in a better spot to retire. And you guys are now solving that problem for loan officers and realtors who want to invest in their own business.
Absolutely. And that was Brian Bomar saw this when he was 32 years old in the mortgaging space. So it was incredible. He stood up Whiteboard CRM. He stood up TrustPoint Insurance, which eventually became Nakama, and scaled it out to the market. And he did all of this not just for himself. He brought all his people with him on these deals, and it was phenomenal. And it's still, you guys still kind of got to get out of your own way a little bit, right? A lot of folks want to own their own insurance agency, and they're like, hey man, I send it down the street and they do push button get insurance. Give me push button get insurance. I'm like, well, do you do push button get mortgage?
Right.
Well, why don't you do push button get mortgage? Because there's no connection there. You don't believe in that. So why would you believe that with something as important as insurance? I mean, It's mandated by law that we have to have it. Like, we want to take care of your clients. And so there's a lot of aspects of when somebody stands this up, they've got to be willing to be a little bit malleable. But I mean, dude, how much time did you actually spend working in or on the insurance agency in the 2 years?
2 hours a quarter.
Right. I mean,
maybe an hour a month.
Right.
Maybe.
Right. And this is an asset that is going to pay you out long term. Now, granted, we're in a little bit of a hole in the standstill because we got kicked in the teeth by California.
Right.
But what we're going through in insurance is generational. It's very similar to mortgage. We've never seen anything like this before.
Right. You guys are going through your version of 2007, 2008.
I think we're going through our version of 2022 through 2024.
Oh, okay.
Because, correct me if I'm wrong, I've talked to hundreds of loan officers about that. This is worse than 2008.
That's an interesting take, because I think it is worse in the sense that people don't understand why it's going wrong, right? In 2007, 2008, it was simple. It was like the economy's crashing, property values are going down, lenders are scared. But right now, it's like this weird bastardization. So yeah, it is probably harder mentally, because it's like, wait a minute. The stock market's at an all-time high at 40,000. Property values are still going up. People seem to have disposable income, but I can't get like a deal put together because there's just not a lot of deals out there. So yeah, I don't think it's as dramatic or like painful in the overall economic sense, but it probably is harder.
It's longer too, right?
Yeah.
I mean, we're 26 months in. I mean, April 2022 was when it all hit us. All of a sudden, we went from maybe writing a 30-year fix at a sub 3% loan in March to April, it's 4.5%.
Yeah.
And that was like, oh my God, what would we do right now for 4.5%? Oh my goodness, we'd all do backflips.
Right.
And then that just continued until we got to 8% in October of last year.
Yeah.
And now we're just hanging out in the sevens, like, cool, man, 7.25%, right? I'm closing on Monday. I'm so excited about this, right?
Congrats on the new house, by the way.
Thank you. I appreciate it. But I mean, that's two consecutive years. I wasn't around. I wasn't connected with mortgage. I only saw it from the side back in 2007, 2008. But it really felt it really hit us in 2008, right? September, right? So it felt like by the start of 2010, we were on the way a little bit.
Yeah. People were buying houses again. The loans were hard to get through, but people were at least motivated by the lower prices, and they finally thought that they were getting like a deal.
It's kind of funny. I heard this yesterday, and not to get too political, but and I will if you want. It's fine. I was unaware of this because it wasn't relevant to my world at the time. But the Obama administration was a lot more friendly to mortgage than this current administration.
Yeah.
And I mean, you have the Republicans that say that Obama's behind the scenes pulling all the puppet strings. Well, that gives me a little bit of pause for cause there, because what I heard yesterday was kind of shocking to me. Is like the Obama administration was much better for mortgage.
Yeah.
Frankly, than the Biden administration's even been close to.
They were trying to find solutions, whereas right now it's really just a rate problem because the products are out there, right? I just did an interview with Tim Herman, started a company called Up Equity for bridge loans, and they're trying to solve a problem in the marketplace of like people are captured in the house that they're in. They don't know if they're going to be able to find their replacement property without pulling money out of the property they're leaving. So it's like they're serving that market niche where like the products are there. It's just the motivation to sell because maybe you're captured by a 3% interest rate, or the motivation to buy because everything feels expensive. It's just tough to piece a deal together. Like,
well, maybe we should have done the $8,000 tax credit again instead of just giving out government. Just here's a check in the mailbox, right?
Right.
I don't know.
I don't think we're going to solve the problem until a politician has the guts to say, okay, I know there's a lot more buyers than there are builders, but we keep incentivizing the wrong side of the equation. We're incentivizing buyers. We're giving them credits and grants and down payment assistance. That's not the problem. Talk to any realtor in the country. There's plenty of buyers. There's not enough property. So if some area or some governor of Oklahoma or Texas or something comes in and says, hey, for every unit of housing that goes online, we're going to give you a $10,000 on the spot tax credit. Then the builders would have some motivation to like step up, right? You know, they build 400 housing tracts. That's a lot of money in government subsidies. And I think until they start shifting the money that's subsidizing the buyer to subsidizing the home builder, I don't think we come out of this problem, because you saw those graphs yesterday. We're just not building enough houses for the legal and illegal immigrants that are coming here, plus the normal household formation, plus the birth rate. We're like millions of houses per year behind what we should be building.
Right. I've been watching Barry on stage speak for the 5.5 years I've been in this business, and he has talked about this in every presentation. And his son did such a good job. Pray for Barry and his health yesterday of presenting the same things, because it's not freaking changing, man. It's like right. Every time I saw that, I was just like, why are we not building more homes? And then you compound that fact. We talked about California a lot. Californians now are selling their homes. They're selling their 2,000 square foot home in the greater Los Angeles area or Orange County or San Francisco or wherever it may be. They're selling that house now for $6 million. They're moving to Idaho. They're moving to Oklahoma. They're moving to Texas. They're buying a 4,000 square foot home in the absolute best neighborhoods for $2 million, and they're stroking a check for cash. And it's like, well, okay, cool. Good for you, but that isn't helping folks in the mortgage space. You know who else it isn't helping? Maybe if you're that liquid, why do you need to have insurance? You no longer are required to have homeowners insurance. You own that house outright. You stroked a check for it. Maybe you don't need it. And so there's ancillary economic implications to that are not overall good for the economy. And it's a challenge right now.
Yeah. So talk a little bit about, with comma, get rich slow on insurance, you know, and I don't mind sharing like our kind of thesis was, okay, cool. I think we put $100,000 at the time. I think that cost is a little bit higher now because you want to pad it about 120. So we came up with $100,000. We capitalized the insurance agency, and I'm going to bastardize some of the numbers, but roughly it was like, hey, if you guys refer in about 20 policies a month, and or the insurance agent who we hired goes and finds that difference by self-sourcing some deals, about 20 policies a month, you know, over a couple years, you start to get the residuals. We have a good renewal rate. We have great operations staff behind the scenes. When you get to year 10, you'll have an asset that you could either resell the book of business back to comma or go sell it in the market for about $2 million. And me and the guys were like, cool, man, split 5 ways, $2 million, not going to be life-changing money. But around retirement, if we can buy an awesome beach house in Cabo and an awesome cabin up in Lake Arrowhead, cash, because we sell our insurance agency, and now our 5 families have amazing places to vacation during retirement, that's a pretty big win for doing nothing else than referring in insurance to like a trusted source who's actually going to take care of our clients' insurance needs. So am I kind of like conceptualizing the path to like growth on this, or am I messing something up based on current numbers?
No, absolutely. It's an alignment, and it's going to change because our cost of doing business has not fundamentally increased with the levels of premiums. So right now, when I model it out at a 3.5% premium increase. There's no such thing in America today, but it is what the 10-year rolling average has been prior to 2023.
But now we're seeing 5, 10, 20% increases in premium.
50. 45. 50. I mean, I bet you the average is in the high 30s.
Which means the book of business on that insurance is just getting more profitable because the premiums are higher.
It is a recession-proof inflation-proof business because it is mandated by law. But typical models, what we look at is we look at 25 referrals a month and about a 40% close ratio. So that means you're putting 10 households. You're getting 10 households to write insurance with, and then of those 10 households, we're going to get 15 policies. Half of them we're going to get cars. It's just the way people are when they're going through the mortgage process. Right. They don't want to deal with bringing their auto over. So that's 15 policies. The agent will bring in some of their own. So you're exactly right. So now we're looking at about 20 policies per month. That gets us around 240 per year. And the first 2 years, that basically covers the $60,000 that we put to your operating account that we pay all the bills for. That's of that 100,000 you talked about. It's 110 now. And then really the long term, 6x is typical modeling when we look at it in 5 years, and then just like you said, 20x by 10 years. And then that's a 2.5. That's three and a third increase from year 5 to year 10. There's nothing that says you can't extend for 5 more years. I would imagine that number would double from 20 to 40 in that time frame. Now, those numbers are all dependent based on where you're at. State of Texas, state of Florida, state of Oklahoma, ridiculously expensive insurance. State of Utah, I think they asked for $3 and some peanuts. I mean, even though Utah's escalating really high, and I'm like, oh, I'm sorry, your homeowner's policy went from $300 to $400, dude. I really feel for you. Like Utah, Maine, Idaho, there's just places that don't have natural catastrophes, right?
Yeah.
And the Midwest is like, bring that all day. Hail, right. Tornadoes, floods. We got all this shit in the Midwest. And so those are all really states with good premiums when you own an insurance agency. They right. suck when you're just a homeowner, but when you own an insurance agency, it's a pretty nice place to be.
Yeah. And then, I always try to think of like, where is the person in the audience rolling their eyes? And I'm like, oh, maybe somebody might be saying, oh, this is a conflict of interest. You're making money off your client in another way. But I can say for myself, in the 24, almost 25 years I've been doing mortgage, I've made 3 insurance agents insanely wealthy. I rarely get a thank you. They rarely do a follow-up with the client. They're rarely reshopping rates for them. They're rarely doing anything other than, hey, thanks for the referral. Oh, by the way, because a lot of loan officers refer deals to me, I really can't ever refer you a deal back. And Scott, even when they're refinancing, I don't hear from them until the transaction's over. So it's like a very usury relationship that realtors and loan officers have with their insurance agent, who frankly, because all of this shit is state mandated, no one insurance agent is doing anything better than another on the policy side of stuff. So as long as you and I find an agent who's world-class at customer service, like I personally don't see any conflict of interest. But where have you heard people maybe like poke holes in this, or where's the fear?
I think there is some of that. There's some folks who have a great relationship with their insurance agent, right? And it's mutually beneficial, right? They're referring people to the loan officer to write loans. That's not LA, right? That's not Vegas. That's Waco, Texas.
Yeah.
Right. That's Tulsa and Oklahoma City. We certainly fit in that. The more rural areas, even though those are somewhat sizable markets, but they seem to have more loyal partnerships in that regard.
Yeah.
The other aspect is like when you're a loan officer of substance, right? Like what you're doing. You're walking your client through the benefits, and you're doing a cost-benefit analysis of buying, and you truly are that advisor, and you're that high-volume loan officer that is growing and building a network. And when you refer your clients to your insurance agency, they listen to you, man. Like my loan officer he'd tell me anything to do financially, and I'm listening to the guy. Like he walked me through the Burr method, helped me get my first real estate investment up and going, and Sam, I'm going to say his name, Sam Birch, a phenomenal guy. And so when I think about that, if he tells me, hey, this is who you need to use for insurance, I'm listening. Now, the challenges and the eye rolls come, like I refer to Bob Smith of Bob Smith Allstate. He's got his name up on the billboard. Like he's wearing 3-piece suits. He drives a Maserati. He's got a country club membership at every country club in town. Like the guy runs a tip-top operation. Yeah. He's been doing it for 30 years. He's not going to be your insurance agent when you own a common insurance agency.
Right.
It's going to be a junior agent. It's going to be somebody who is not as skilled as he is. Now, granted, he's not doing it either. It's like, just seeing Champ Benosian this week. I mean, how many loans is that guy actually getting in with the client and writing? I mean,
right. Zero.
Unless it's like a $9 million, $35 million loan or something, with Jalen Brunson and the New York Knicks. Yeah, maybe he's doing that for him because it's got some curb appeal to it, right?
Right.
Same with Bob Smith at Bob Smith Allstate. He's not getting in there, but he is. Oh, you've got somebody you can reach out to because Bob knows you're valuable when the shit hits the fan on insurance, right? So that's the aspect of you're utilizing a much less seasoned agent, so you can make some money, right?
Right.
I could go hire a 10-year veteran. You're never going to make any money because I got to pay that guy so much, right?
Right.
And so that's the aspect of it.
Well, and I have found with when we were doing the search looking for younger insurance agents, it's like any other job. You can get core competent in a couple years, and then it's just a matter of do you have the chops to be a salesperson or manage a team or run a business? And what I like about it is if you get somebody in this insurance agency position like we did, who's very core competent, but was never going to be the number one person on a sales team. Well, it's she doesn't have to worry about that because the founders and the owners of the company were bringing in the referrals. So that person can just be an insurance agent, doesn't have to be a salesperson. And then if they grow and if they end up having to get an assistant and run a bigger business, they don't even have to be a great business owner because Comma handles that and you guys do all the logistics.
Yeah, absolutely. I mean, I'm not gonna besmirch your agent, but I mean, she had trouble sending emails. She couldn't spell people's names right, but she was like your favorite goofy aunt, and people loved her, and she wrote good insurance until she got kicked in the teeth. If we didn't get hit with the hammer in California insurance where we weren't able to write, she'd still be around. She did a fantastic job. So yes, there's that aspect of it. You got to find the right person to do that. And I'll tell you this, this is just anecdotally gut feeling. The level of candidates that we're finding right now to take these jobs tells me it's a much more employer-friendly market. Right. Yeah. We are getting employees that are looking to us that want to come work for us and want to come work for the agencies that we're standing up. And these folks are super talented right now. They are far more talented than what I was seeing 2 years ago. And I don't think, and I'll give credit to our recruiting department. I think we're getting better, but we're not getting this much better. It's just people are looking for jobs, right? The jobs aren't there. The jobs aren't there. We're in a freaking recession, folks, whether the BLS wants to lie to us or not. And I think that they're keeping rates where they're at because there's direct correlation with the stock market. No sitting president wants to decrease the rates and then see the stock market go in the tank and try to get reelected, right? The number one way to get reelected, strong economy. It's it. Right. You could be the biggest jackwagon in the world. The economy's not strong, you're not getting reelected. Right?
Yeah. So give us an idea of the scale of the problem in California, which we've talked about a little bit. We had our 5 go-to carriers, and then we had our 5, they're still great carriers, but they're a little harder to get applications through in the time. And then we've got 3 or 4 fringe, if everybody says no, these 3 fringe people, they will absolutely do it. So let's say we started with 13, 15 carriers, maybe 2, but 15 carriers in California. In the Comma ecosystem, how many of those 15 are actually still writing insurance in California?
Maybe 2, maybe. And it's limited. Like, for instance, Safeco's great to us. Love Safeco. It's a great company. Think really highly of them. They limit, for instance, we still have California agencies that are open and running, and we got one agency for it. Still, it's printing money, even though they're not writing new policies, because we got them open in 2020 and it stood up, and the agency's worth 3x what they paid for, and they're getting dividends and returns, and it's awesome. But we're not writing new insurance there because we can't. It's just not enough. We can write a couple policies a month, and that's literally what Safeco's doing. It's hey, we'll give you 2 HO3 policies a month. So
Safeco is saying, hey, we'll stay on as one of your carriers,
and we can't bundle anything. We can't bring an auto on any of these.
Yeah. So Safeco, one of the biggest insurance providers in California, is saying, hey, we love Comma, we love the relationship. We're going to stay on your carrier network, but each insurance agent in California can only write 2 policies per month because we don't want to be overexposed to the California market.
Correct. And I don't. Holy shit. And it even got to a point where I don't think that we could write 2 per agent. We got 2.
You got 2 for the company.
2 for the company. We have 1 current agent writing in California currently.
Oh my goodness.
A year and a half ago, I had probably close to a dozen. I mean, it sucks. It's hard. Right?
Yeah.
And Texas is, and you know what? Texas is, now I got 4 in Texas. 3 maybe.
Yeah. Texas having the same problems. Florida having the same problems.
Florida, at least, we got 4 or 5 in Florida. It's just, the Florida consumers have been shopping insurance for decades.
Right.
They're just different. So there's a little bit different animal there. But
I remember I did a loan in Florida as a favor to a realtor of mine. She's like, hey, I can't remember what it was. It was like her mother-in-law or something has a condo. She's just trying to improve her cash flow. So we want to take like this $80,000 loan and stretch it over 30 years. And the realtor was great. She was like, I could pay off the $80,000, but like my mother-in-law doesn't want to feel like she's taking any charity. So can you please just do something with this $80,000 loan that, used to be a $500,000 loan. So she's got a couple more years left to pay on it at $2,500 a month. Can you just take the payment down to like $300 or $400 a month? So she feels like she's still paying it. I'm like, yeah, fine. I'll do this $80,000 refinance for you. I think I lost money on the deal by the time I paid taxes and my assistant, but whatever. So I did the deal. And that was, this is about 5 years ago when I started doing loans in Florida. It was eye-opening because her insurance was more expensive than her mortgage payment. She was like right on the beach. The house had been blown down in like Hurricane Andrew and Hurricane this. And so her insurance policy was like $7,000 a year. Her insurance costs ended up being more than the cost of her taxes and mortgage combined. I was like, holy shit, what is going on with insurance? And that's when I found out like, yeah, Scott, do you think you should be able to insure a $3 million house in the Hollywood Hills for $2,000 a year? Like our market is all out of whack.
Well, in Florida, it's like, if you're going to live in Florida, the only places you want to live are directly exposed to hurricanes.
Right.
I mean, if you live in the central part of Florida, I'm sorry there's a reason Disney World's in Orlando because it's literally the armpit of the United States. I mean, Orlando sucks.
It's all swampland.
It is all swamp. Right? It's hotter than hell. There's no ocean. Like, there's a reason why they did it there. It's not a desirable place to live. And now it's still one of the fastest growing cities in America because of a lot of different reasons. Obviously, the sunshine tax, and you can get to Tampa pretty easy. You can get to Palm Beach pretty easy. You can do that stuff, and you can experience the good things of Florida. Well, at least in California, I don't have the same feelings about like living in the valley. Like I don't think like the valley is like the armpit of America.
Right.
You got some mountains, you got some breeze. Yeah, it can be hotter than hell in the summertime, but and you got fires to worry about. But dude, if you live in Florida, like, and if you're not in Orlando, even if you're in Orlando, you're in Hurricane Alley, man. Like it's coming. Like it's not a matter of if, it's when. So
right. So
that's the challenge.
What did I forget to ask about insurance, about about like the idea, like why, maybe talk about like, we talked about the wealth creating opportunity. Why would a loan officer or a group of loan officers want to get together and do this now in 2024 when money's hard to come by, things are tough? Like why would somebody want to lean in on a down market? And then what's kind of the profile of the loan officer or the loan officer group collective that you're looking for?
Right on. Why would you want to do it now? Because the best time to own an insurance agency was 20 years ago. It's like planting a tree, right? The next best time is now in certain markets. I frankly, I won't stand one up in California today. I will not do, like, I am not going to take your money
right
and then bleed you out a slow, like, if you're willing to invest $250,000 today in California, we could talk about that, but that sucks. I can't get you the ROI you want. You guys are too financially savvy in your roles, especially if you're going to be one of my owners, right? But elsewhere, yeah, we could still do this, right? And here's the thing. I stood up on stage this morning at Mastermind and looked out over the group of loan officers, and, God bless them, there's, 300-400 people in there. Maybe there's 600 that are attending this thing. Like, what was that number 3 years ago? 1,500?
1,500.
Right? Now, granted, people had a little bit more money to spend, yes, but dude, a lot of those people that were in that room 3 years ago aren't in the business, right? The people who are here, the people who are capitalizing this, the people who are taking care of investing in themselves, the market share is there. You got to go out and get it. And I'm noticing a dramatic change in psyche and morale from loan officers to the point where it is what it is. Like 7% interest rates are what they are. People are moving. There's actually inventories popping up. Danielle Dean Martino Booth said that yesterday. In Texas, it's at a 5-year high of inventory. So there's opportunities. Home values are going to start to come down. Rates will start to drop. It takes probably 3 to 6 months to stand up an agency. The election will have some impact on things, but I firmly see 2025 as, I think carriers have regrouped. I think they've put the opportunities out there. I think by 2025, we'll see some opening for carriers or softening or appetite, whatever you want to call it, especially in our most challenging markets. And I think you guys are really going to grow in 2025. I think there's going to be a huge opportunity for it. And so that kind of aligns with why you'd want to do that now. What was the second part of your question?
The demographic of the type of loan officer collective you're looking at. Because like I knew I wasn't going to be good for 20 referrals a month.
Right.
So, and I also wasn't good for 100 grand, 110 grand now. So, for us, we're like, hey, can we get 5 guys together that can each put in 20 grand? We can work together nicely for 10 years and we can all commit to 5 to 10 referrals each, right?
You spend more on cigars than you did the UCLA Bruins. Let's be real. No, you're exactly right. So what we need is we need volume, right? We need an entrepreneurial based loan officer. And I don't kid yourself before you step into this. Ask yourself, are you really entrepreneurial based, right? Are you really willing to change your processes? Are you comfortable with how you're doing things and comfortable with where you're at? Then you're probably not right for this. If there's discomfort in looking at your long-term wealth, your long-term assets and what that's like, then maybe I'm not right for you, because there's got to be a little bit of discomfort. Like I said, you have to change how you refer. You got to be willing to step into it. Like I use one of our guys in Georgia. His name's Eric. And I asked him in I think in 2023, he wrote 350 loans in 2023. Like the dude's a beast, man. And he's phenomenal. Guy never comes to any of these things that we're at this weekend. He couldn't care less to be on stage. He doesn't want you to know his name. So I'm not going to share his last name.
Yeah. He's got I know who you're talking about. He's got his plan.
Right. And I was like, dude, how did you wrote like 300 some odd loans and you got like 300 referrals to his insurance agent. Like, how'd you do that? He's like, I just talked to him. I was like, what? It's like, I just talked to him. It's like, you did 300 loans and you talked to him? It's like, I talked to every single one of my clients. Like, I know people who do 75 loans who don't talk to their clients. So that aspect of why his insurance agency is worth a whole lot of money and he is getting big returns is because he actually still meets with, he's actually said the only thing he talks to his clients about now is insurance. It gave him an opportunity because he's got a huge team, right? Like nobody writes that many loans without having the Leahs, right?
Right.
And so you got to be entrepreneurial and focused. You got to be willing to sever the relationship with your State Farm agent, whomever you're working with. And then we really need 300 units of production, but let's be real, it's 400, 500 is better. You also be willing to do like you did, right? You walked into an agency that you own 20% of. And just like you said, 20% of $2 million is cool. It's not life-changing, right? We have so many folks that are like, dude, I want 100%. I'm like, you want 100%, then write 400 loans yourself. Right. Because that's what's going to take. You can do that. But you got to be a 400, 500 unit loan officer. And even then, so now you got a $2.2 million return, but if you're a 400, 500 unit loan officer, you're making $1 million a year, right? So it's not necessarily, that's $2 million in 10 years is not necessarily life-changing either. I think that so many people want to look at this and say, well, dude, if I bought Bitcoin in 2010, like I did, like I should have, when a guy told me on a plane and I could not understand what the hell he was talking about, I looked back and the coin was worth $13. I wish I just bought $100 worth of coins, right? This is not that. Right. This is not that. This is significant ROI for less than what you're going to put into a real estate property. It is way less effort and it's significant ROI. Yeah. It is not game-changing FU Bobby Axelrod money. Right. It's just not. It's not. And so I think there's a level of you have to understand it. This is supplemental and it requires such little freaking work. And here's the other thing. If you're a loan officer and you've been in this game for more than 5 years, you've got a boatload of clients. If you're good and you're the person I want to talk to, if you're willing to reach out to them and see what we can do for them for their insurance, you have to be willing to do that. You have to put that in your CRM. You can't tell your insurance agent to go market to your clients. It's the dumbest shit I've ever heard. And I know people, they do it all the time. And I'm like, guys, if I show up in your client's inbox, I'm a VP of business development for a multi-million-dollar company. Like, I speak on stage. I've been a professional. They're still deleting my freaking emails, dude. What are they going to do for your $60,000 a year insurance agent? They're deleting that crap. It's got to come from the person that created the relationship. And you want that. You want that client to remember that you were the person that helped them with their insurance when it's hard.
Yep.
Now when they got to refinance, when they're going to refinance in 2 years or they're going to move in 2 years when rates finally come down, they're going to remember you in a different way other than, hey, it's springtime, time to plant flowers.
Right.
Or, hey, don't forget to move your clocks.
Right? Oh my goodness. When I get the 97 emails that are exactly the same from all my agents who work at whatever brokerage, and the brokerage puts out it's time to spring ahead or fall behind, I'm just like, it's to the point now where it's offensive. It's like, I have an iPhone. We're effectively rich. If you own an iPhone, you are in the top 5% of income earners in the world. Like, the phone sets itself. It's amazing. It just falls back and springs forward, and it's It's actually comical. All right, so you're looking for that kind of conglomerate of loan officers who are doing a couple hundred deals a year. What's the future look like for Comma? Like, are you guys just constantly navigating these state by state issues? Like, are you still growing even in this crazy insurance market? Like, what does it look like for the company?
We are. We've diversified some things. We've opened some commercial opportunities. We are looking at acquisition of small agencies, folks who want to get out. There's a lot. There's boomers who have been running, for lack of a better term, some middling agencies that we're willing to look at. We are going to look at the opportunity to buy those agencies, so maybe set up residency in certain states, because there is advantages to setting up a subsidiary of Comma in Texas, in Florida, in California. California will probably wait till the legislation truly passes and moves forward. We've done some owner-operator models. We've done like everybody else. We've had to pivot, right? We've had to get creative with this thing. And, for your agency, we're actually marketing your clients that you referred to your Comma insurance agent, a year ago, 18 months ago, and seeing if we can't get them back in the fold. We believe that could still benefit your agency. So, like, there's a lot of things that we're trying to do on the back end. It's a challenge because when you own your own insurance agency, it's your agency. You are not beholden to Comma for anything. Like, you could have a really wealthy asset and you're like, screw this, I just don't want to do this anymore. I'm out. Like, so there's the levels of like trying to navigate that. But yeah, we're still full go mode, man. I'm out here for a reason. I'm going to be out here next month at Forward Academy from Neil Dinger's event. I'm going to shake all the hands, kiss all the babies, do all the things. And here's the reason why. I truly believe in what we do, right? I didn't think I was going to get into this. I didn't think this was, if anybody's lasted this long and they're listening to this, they're in the mortgage space or they're in the real estate space, because the average, the guy I listened to on your podcast a couple of episodes ago was open to everybody. This has really got hyper focused in the mortgage space. So I'll share this. I was 10 years old and I watched my dad be arrested on TV. I knew he got arrested already, but the defining moment was that moment on the Channel 3 news, because everybody's parents watch the 5 o'clock local news and then 5:30. If you're a Gen Xer, you know that. Like, that's what they did. And I remember I was with my mom and I saw it and it was devastating. And then
You watched your dad get arrested on TV?
Yeah. Embezzling money. That sucked. And then my brother went to prison when I was 13. Like, my hero, 11 years older than me, he went to prison. And it's funny because my wife helped me understand this. And then I'll credit Rene Rodriguez too, because he planted the seed that made me think about it. My wife's like, how did you become successful? Like, why are you who you are? Like, you've always been career oriented. You've always had bigger visions and goals for yourself. And one of the things I realized is there were gentlemen like, and I'll specifically name Steve Beckett. Steve Beckett is the most prominent attorney in my hometown. Was my dad's best friend since they were like 8 years old. He was my dad's attorney. He is my godfather. Like, when that happened, the fundamental, and he and I talked about this really recently. It was subconscious because he wasn't intentional about it, but he was intentional. He put his arm around me. Like, he took me to things. He took me to Illinois basketball games. He took me to Illinois football games. So when Illinois, Deion Thomas set the scoring record at the University of Illinois, I went to the post party. I was a huge sports fan. I wish I could be like you and turn it off, because it is a waste of time. It doesn't generate me any revenue. And it pisses my wife off and it pisses my kids off. But this is a hero moment for me. I'm Deion Thomas, the school's all-time leading scorer, and I'm there at the party, and I'm talking to Quan Garris and Jerry Hester and these guys who are like end up being Illinois legends. This was the coolest thing in the world, and he's a prominent attorney, and like he invested more in me, and I realized I could be something. Like, that wasn't free. Like, he did all kinds of things for me, and they weren't free. He was able to do it because he had income. And so my thought process is, what I do is I help wealthy people make more money. Right? Because you can't invest in this unless you have some modicum of wealth, right? And I truly believe, Chris, don't throw anything at me, that wealthy people with more money in their hands do good things for the world, right? And granted, 9 out of 10 are going to do it. One's not. I'm fine with batting 900. I played baseball. I wanted to bat 300. In this space, I'm fine with batting 900. Is that understand that this can fundamentally change the way that you look at your retirement and how you can ease yourself out of this business. As a loan officer, as a real estate agent, you are the conduit to the American dream, and that is owning a house, right? And owning a house is one of the biggest things you can do to change generational wealth. It is fundamental in changing generational wealth. Do we have a race problem in the United States? Absolutely. I'm not going to sugarcoat that. We have a bigger socioeconomic problem. Like, you could be a white kid born in a trailer park, or you could be a black kid born in the best part of town with 2 parents with PhDs. You tell me who's more privileged. I'm sorry. It's the socioeconomic family that's better off, that's putting their kid in the better school, that has better health care, that has all the things, right? Than the poor white kid or the single mom meth head in a trailer park. Just because he happens to be white, don't tell me he's got more privilege than those folks. He doesn't. Now, he might have more privilege than those folks in certain situations. But the fundamental change is, like, the more people we put in home ownership, the better this world is. Crime rates go down, right? Property values go up. People take more ownership of their things. They're able to pass something down to their kids. So what mortgage and real estate folks do is really, really valuable. The last thing I want is a loan officer who's been really good at their job that's having to do it when they're 65 years old and they're tired and they're burnt out and they're not willing to help that single mom buy a home because she's got a 580 credit score. Like, dude, if you're established and you've got this thing and you've got a comma that's providing you some more money, you don't have to fight for that. You know what you can do? You can refer it to Kate Ramirez and be like, hey, Kate, this is your specialty. And you can do effective handoff as opposed to just like, I don't want to deal with them. Fuck them. Get them out of here. Because I hear that sometimes. Like, I just don't deal with the hard loans. Cool, man. All right, I get it. Do you have a referral partner for the hard loans? Nah, it's not worth my time. Do you refer them to credit repair? Do you take care of people on that? Nah, not worth my time. That shit drives me nuts because owning a home is fundamental to the American dream. And then I get the second part of it. My friend Kai McBride always told me this. He's like, the second part of the American dream is entrepreneurship, and I get to provide folks who don't necessarily have a direct avenue to do that for them. So sorry for my rant.
It's a pretty impassioned rant, though.
I give a shit. I give a shit, dude. Yeah. I mean, I say I love loan officers, and I know some people roll their eyes like, screw you, no, you don't. I really do. I love what you guys do because it's important to who we are as a society. And that's why some of the stuff we talked about early in the show kind of scares me. I mean, home ownership is harder than it has ever been. Not only are we talking about 7% interest rates, we're also talking about massive increases in insurance. Like, I'm going through it right now, dude. I got canceled by State Farm, but I have one claim in 20 years, and they told me I can't write with them. Right?
Oh, yeah.
Because I was balancing. I'm shopping, dude. Yes, I work for an insurance agency. I'm not beholden or blind to the company I work for that I have to bring my policy over. Frankly, it's not worth that much money. Like, it's more impactful to me to save money.
Right.
But dude, it's nuts. It's hard out there, man.
I was talking to some loan officers from California, and we still have a place down there that I'm in less than 180 days a year because I live in Nevada 180 days a year if the state of California is listening. And yeah, never has had a claim, has paid their premium for 12 years on a 4-unit house, nothing. And his insurance agency just said, hey man, you got 6 months to find a replacement because we're not renewing you because it's not worth it. So it's like, it is harder and harder to own a home in America, which to me says it's more and more important. Right.
100%.
Because 100%. In times of inflation, in times of like economic turmoil, like the people who own assets, they weather the storm better than the people that don't.
Right.
So,
I mean, the Danielle DiMartino Booth, I've mentioned her like 4 times on this show. She's up there talking about the bleakness of the economy. And the whole time I'm scared, but I'm like, Danielle ain't worried.
Yeah.
She's got multiple zeros in that bank account, dude. She's doing all right. And like, I'm not hating on her for it, but it's just a different situation. Right. And
yeah.
I think it's more important than ever that the hard loans get some focus. And maybe if it's not you, like I'm challenging everybody, like find somebody who's good at it. Right. I know those are typically younger loan officers that come in the business because they gotta take the shit that rolls downhill. But if they're good at it, God bless them. And if you're listening to this show and you do the hard loans and you work with the people and you work with the single mom, God bless you. Never forget what you do, because in 15 years when you're writing 300 loans and you're not dealing with the hard loans anymore, still care about the people and find a way for them, somewhere for them to go. Right?
Yeah. I always like to end the podcast with 2 questions. Like, what are you most looking forward to? I think I already know the answer to this question, but what are you most looking forward to going into the second half of 2024? And then favorite movie and why?
What am I most looking forward to in the second half of personally, I'm moving my house, man. It's really exciting.
You're buying the forever house, right? Like this.
My wife doesn't say so, but dude, this house is, oh God. I mean, my dad and my mom asked me to send them some pictures, and there was that moment of like, I'm kind of embarrassed, right? It's bigger than any house they've owned, and it's really nice, man. It's really cool, and I'm super stoked about it. And for my daughters to be able to have a better place to play out front, like my neighborhood is really tough for kids to play out front because people speed. It's a main entry into the subdivision, and it's got a big backyard. I'm going to put a concrete slab in there. I'm going to put a basketball hoop so me and the girls can play together, and I think it's going to enhance the overall quality of our family life. And we're kind of homebodies now, to be honest with you, man. Like, I go out in Vegas because I'm in Vegas for work, and I got to shake the hands and kiss the babies. I go home. Friends ask me to come out. I'm like, I don't do that, man. Like, you want to?
I'm watching the game, bro.
You want to come over? I'll cook out. Like, and so this house is going to be really set up well for that. So that's for me what I'm most excited about. I know maybe some people wanted to talk about business. I don't think we're going to see enough of changes in the business world from a mortgage rate standpoint or a carrier appetite standpoint before 2024 wraps up. Yeah. I'm really excited about 25 though.
Yeah.
But I was really excited about 24 and 23 from a mortgage rate standpoint, and just getting kicked down the line. But favorite movie and why? Good Will Hunting. Has to be Good Will Hunting. There's some moments in the movie, I shared my story about my dad and my brother, and like, your two closest male relatives, convicted felons, and dude, like, my dad and my brother are really good people. And I know a lot of people will shake their head at this dude. Like, my brother hasn't so much got a parking ticket since he got out of prison, right? He's got a fantastic job. He's kicking ass. He's taking names. He's got a great wife. His life is good. Like, the fact that he got knocked down like he did and got back up is so remarkable. But I remember the scene, like, Robin Williams is like, it's not your fault. Like, it resonated with me. Like, I used to take the burden of what they did and think it was my fault. I used to think, like, dude, I'm just, I'm just like them. I'm poor white trash, whatever, and they're not. Like, it's just, but there was this, like, subconscious level of, you can be something more than what you're not. And plus, like, of course he loves those guys because they take a baseball bat to anyone. Like, dude, I got a crew of homies like that. Like, I got my
right,
dude. And it's all funny because we're all presidents of organizations and vice presidents and leaders, and it's funny because we were hooligans, man. We raised some hell together, dude. And like pharmacists, like, dude, it's all my homies are doing fantastic. But like, literally 20 years ago, they would have taken a baseball bat to somebody's head from me, like, and there's just so many connections in that story that I absolutely love. And I saw it with Will Mayfield, Evan Hoser, and Nate Bowers, three of my closest friends that I served in the Army with. And there's moments like my tattoo. Somebody's like, "Will you get it removed?" I'm like, "No," because I know exactly who I was with when I got. It's one tattoo and done in 3 different sessions, and I know exactly who I was with and it's a stupid friggin' tattoo, and I don't like it. I just like the memory of who I got it with. So the level of going to the movie with those guys was really pretty cool too. So.
Yeah, I remember the 4 drunk guys who we got tattoos on the same night in the Army. Yeah, and I got the least of it, man, because we all got something geographically relevant. Huh? So I got a surfboard on my back, but poor Troy,
right above your butt crack.
Yeah. Poor Troy Blossom, for the rest of his life has like praying hands on his chest because he's from the Bible Belt.
Yeah.
This other guy, Chuck Porter, has cactus across his entire chest because he was from Arizona. Yeah. There was another guy from Wisconsin who is not with us anymore, but he got a big cheese head on his chest. And it's like, I'm just going to remember that until the day I die. And it's stupid shit, but it's
like, you never cover that up.
Yeah,
dude.
no.
I'm not getting rid of it. No,
it's very impactful.
All right.
Every once in a while, I'll forget that I have it because on my back. And then one of my kids will be like, "Dad, what, why? What was that thing on your back?" I'm like, hey, you wouldn't really understand. Wait till you're drunk one day when you're 19 or 20, and then we'll have a talk.
Yeah, we got as soon as we could get a pass. So we did one station unit training in Anniston, Alabama for the MP. So it was at Fort McClellan.
Oh, you were an MP?
Yeah.
I knew there was a reason I don't like it.
Yeah, right. So it's 16 weeks at the same spot. So it was like basic training ends and you roll right into AIT. So it was like the back half of it. We finally got a pass and we got to go out on town, and the Fab Five, we all went out and got tattoos. And I got this little tiny tribal shark. I mean, it was like this big, because me and my homeboy Ryan Cattell used to always watch like Shark Week. And I come home and my mom's like, "Oh, that's cute." And I'm like, well, fuck that. I'm getting a lot bigger one. Now I've got this whole tribal sun around, and it's just bad. And my whole family's like, "I love your dolphin on your arm." I'm like, dolphins don't have gills. It's a shark. It's a shark, damn it. But dude, I was with Jake Gray, Jason Stralk, Steve Stopka, Phil Cox. Like, and I can tell you where all those guys are from. Still in a group. Dude, thank God for Facebook. I know people love to shit on it, but it's the aspect I can stay in contact with those guys. I got all their numbers later in life because we got out of the Army. I didn't have a cell phone.
Yeah.
The only dude that had a cell phone was Bowers. I don't know how that rich fucker had a cell phone, but we didn't have cell phones. We were broke, dude, right? And there's no money in the Army, so.
That's wild, man.
Yeah, that's great, man.
All right, dude. Well, we're going to have you on after the election 2025 when carriers hopefully start opening up. We see some better interest rates. We'll have you on and get an update, and then we'll talk some more insurance stuff off the air.
Well, hopefully it was entertaining enough. Like I said before, man, insurance is a boring ass subject, but I hope some folks got enlightened today, and I appreciate you having me on. You've been nothing but fantastic to me. I'm going to share this story about you. I've been in the insurance business for all of about 7 minutes, and big shout out to Mike Fisher, who I got connected with through Next Level Loan Officers. I go to an event down in Orlando. I meet you. I meet Kai McBride. And I had no idea who either one of you guys were. You were just some dudes at a mortgage conference. And I just shouted out both of you guys. And both of you guys were like, hey, man, cool. Kai's like, let's go golfing. And I'm taking pictures with him, putting it on Facebook. And be like, everybody's like, how the hell do you know Kai McBride? I'm like, I don't know. He's just some little Asian dude I know I'm playing golf with, And then you, like, I talked to you one moment. You're like, dude, I'm going to put you on Facebook Live for the entire consolidated coaching group. We're going to talk about whiteboard. It's just like, Chris and I were actually talking about this. Is like, dude, you've got this gruff, like, fuck you persona a little bit. Like, my beliefs are my beliefs. But dude, you're such a genuine human being. Like, you really care about people. And the people that know you and come into your circle know how important that is to you. And it's a kudos and a testament to you, the human being. And I felt like it's my duty to say so when I have this opportunity.
Thanks, man. Appreciate it.
You deserve it.
Thanks. Talk soon.
Yes, sir.